Ladies and gentlemen, good day and welcome to the Capacit'e Infraprojects Limited Q4 FY22 conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shreya Manivanan from IIFL Securities Limited. Thank you and over to you, ma'am.
Thank you, Mike. Good morning, everyone. On behalf of IIFL Securities, I welcome you all to the earnings conference call for the fourth quarter and FY22 for Capacit'e Infraprojects Limited. We're pleased to have with us Mr. Rohit, Executive Director and CFO, Mr. Alok, President Corporate Finance, and Mr. Nishit, Head Accounts and Taxation. We will have the opening remarks from the management followed by a question-answer session. Thank you and over to you, sir.
Good morning, everyone. We would like to extend a very warm welcome to our Q4 and FY22 earnings call. I hope that you and your loved ones are doing well. Along with me, I have Mr. Alok Mehrotra, President Corporate Finance, Mr. Nishit Pujari, Head of Accounts and Taxation, and SGA, our Investor Relations team. I hope everyone has had an opportunity to review our results. The presentation and press release have been posted on the stock exchanges and our company's website. Before I take you through the operational and financial performance, I would like to highlight a few points. For the Indian real estate sector, FY22 has been an exciting and a challenging year both. The sector has made significant comeback aided by healthy economic growth and sector-specific government initiatives. The pandemic-inspired trends, together with low interest rates, affordability, and other favorable factors, fueled the sector's progress, and it is expected to continue to do this in the coming years. Commercial properties are equipped with latest technological advancement, which results in achieving new standards. In the commercial sector, flexible working spaces and co-working have emerged as a prominent market segment. Net leasing is expected to increase as majority employers resort to work from office. The real estate volumes were higher than pre-COVID levels on back of receding impact of COVID-19 pandemic. We anticipate a healthy sales traction going forward once the things are normalized in the post-COVID era. Real estate sales will rise up. Despite decline in stamp duty benefits for the consumer, the market is witnessing rise in property registrations. The new launches by large developers will be driven by multiple tailwinds such as healthy sales momentum, demand shift to organized players, which form a big and large portion of our clientele, robust balance sheet, and an asset-light model approach. The second wave of the COVID pandemic had an impact in the first quarter of the last financial year. The change in contract terms for the large client in the private sector for whom materials were formerly included in billings but are now provided by the client had an impact on the accounting revenues in quarter 4. We are pleased to inform that the Municipal Corporation of Greater Mumbai has issued an order for proposed turnkey development of a multi-speciality hospital in Bhandup, Mumbai, worth 599 crores, excluding GST, and at the same time, the company has also received another order worth 227.45 crores, excluding GST, from a prestigious private sector client for construction of residential project comprising civil, RCC, that is shell and core works at Sector 58A, Seawoods, Navi Mumbai. This new orders allows us to diversify our clientele, generate additional revenue, and manage commodity risk via complete pass-through mechanisms. Now allow me to give you an overview of our operational performance during the quarter. The overall order book, public plus private, excluding MADA, stood at 8702 crores as on 31st March 2022. Residential accounts for 30% of the order book, followed by commercial and institutional at 15%, and mixed use at 56%. At the end of March 22, our order book from public sector was 5148 crores, representing 59% of the entire order book, while our order book from the private sector was 355 crores, accounting for 41% of the total order book. Work is progressing at a decent pace on all fronts. Our business model has clearly benefited from our ongoing focus on client service and cash flow management. Our standalone financial performance for FY22 is as follows. Total income for FY22 is 1347.9 crores. Total income impacted to the extent of rupees 45 crores in Q4 due to change in contract terms of a private sector large client where monthly billings are being done without value of steel and concrete, as the same are now being supplied by the client as free issue. EBITDA stood at 226.6 crores with margins of 16.8%. Profit after tax stood at 44.7 crores. Gross debt, including promoters' debt, stood at 328 crores. Net debt remains stable at 128 crores with net debt to equity at 0.13x. The working capital cycle excluding retention improved from 99 days in December 21 to 91 days in March 22, indicating a positive trend. Strong collection efficiency generated 1172 crores in FY22 and 297.39 crores in Q4 of FY22. With this, I now leave the floor open for questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Mohit Kumar from Jam Capital. Please go ahead.
Yeah. Good morning, sir, and congratulations on good set of numbers, especially on the EBITDA margin, given the high input inflation. So my first question is, how much of the revenues you missed booking in this quarter, and what is the revenue and EBITDA margin guidance for FY23? That's my first question, sir.
So the revenue which we could not book in the current quarter due to shift of one big project where the material was earlier being procured by us and in this quarter has been procured by the client as free issue is rupees 45 crores. So if you would have added that in normal case, the revenue would have been close to 390 crores. Second point is on your EBITDA perspective. Our first 2 months of the current financial have seen good traction, and on basis of that, we believe that our EBITDA profile should remain between 16.8 to 17.5% going forward.
So revenue guidance, sir, for FY23?
FY23, we see a revenue guidance upward of 1,800 crores.
And sir, what is the status of Mahada order? We expected to start work from Q4, if I remember correctly. So how much of revenues do you expect to book in FY23? And I think that the revenues will be booked, our portion will be booked directly in the standalone revenues. Is that understanding correct?
Your understanding is correct. First of all, the project has started in Q4 of the last financial year. It has booked a total revenue of close to 125 to 150 crores. None of that revenue is appearing in our books because of certain restrictions in Ind AS 116 identification of income guidelines. And therefore, both Tata and Capacit'e have agreed to subcontract individual works to their individual companies from the LLP, and therefore you will see recognition of revenue in the current financial year. At the moment, there are 6 buildings which are under construction at the project site, and we believe that a total, we have also received the IOD and CC for the sale buildings for 6 towers, and we should be looking at recognizing at the LLP level close to about 500 crores of revenue in the current financial year. It should be remembered that the onus of giving all the permission lies with the client, and these projections are based on whatever has been received and what has been committed by the client to hand over the next 3 months. And therefore, we shall update you during the next quarter's earning call on any change, if any.
So lastly, on the order inflow has been quite muted for us in FY22 and FY21-22. How do you see the FY23? Do you see the order pipeline looking better than last couple of years? And what is the guidance? How do you believe, the kind of orders you would like to get in FY23?
So if you consider that we were already L1 in 3 orders in the last financial year, fortunately, unfortunately, they got culminated, 2 of them in the current financial year. The third one is expected to be culminated also in this quarter or sometime thereabouts. So the order traction from our sense practical perspective has not been muted. Secondly, if you look at our order book as we speak today, is in excess of 9,500, 9,400 crores. Now, 9,400 crores on standalone basis, excluding MADA, is a very sizable order book, which easily gives you a revenue visibility of 4 to 4.5 years, or at least 3.5 to 4 years. So that's one part. Second part, in the current financial year, since you say you have seen a muted last year, we expect to book at least the order value of what we execute. So the trend should be between 2,000 to 2,500 crores for the whole of current financial year FY23.
So what is the size of the third order where we are L1, if we can divulge?
It will be upward of 600 crores. I cannot divulge anything else.
Understood, sir. Thank you, sir, and all the best, sir. Thank you.
Thank you very much.
Thank you. We have the next question from the line of Darshit Zaveri from Ground Capital. Please go ahead.
Hello, sir. Am I audible?
Yes, please go ahead.
Yeah, so congratulations on a good order book and everything. So most of my questions you've answered. I just wanted to ask something, sir. We currently on date have around 9,500 crores worth of order, and as you just right now said that would be a good visibility for 3.5 to 4 years. So, sir, our guidance for 1,800 crores revenue this year seems a bit conservative, and I'm sure we can achieve more than 2,000 crores, sir. Any comment on that, sir?
Let us be a little bit conservative. We shall discuss about revised target, if at all, at the end of Q1 when we have a Concall. And if you are present in that, you may raise this question again, and I'll be happy to answer that. Let me be very honest. We have not been able to achieve what we intended to in the last financial year, and there is no shame in running away from that fact. We worked on the basis of whatever cash flow we had. However, we have raised 100 crores debt at the end of March, which has helped us to ramp up revenue in the first 2 months of the current fiscal, even after providing for the one of the major labor jobs where steel and concrete is a free issue. So answering your question, yes, we have all the ammunition to increase our revenues. But at the moment, let us keep it at 1,800 crores, and we shall look at revising it upwards when we speak to you during our Q1 conference call.
Okay, sir. Thank you so much. And one more question, sir. I just wanted to confirm the commodity prices we are able to pass completely, or is there some lag in it?
I reiterate that we are able to pass our commodity prices in totality in private sector. In CIDCO, the same will be applicable for the new MADA project we expect. In BMC, we are able to bill complete price variation, which at this moment for the January to March quarter stands close to 16% which more than covers the steel and cement commodity price increase. So we may not gain, but we will not lose from any change in the commodity price upward or lower.
Okay, thank you so much, sir. All the best.
Thank you. We have the next question from the Parik from Deep Financial. Please go ahead.
Yeah, good morning, sir, and thank you for taking my question. My first question is on the cash flow. So if I look at your cash flow statement, right, so the overall free cash flow is still negative for FY22. So what I'm adding is your net cash flow from operating activities, which is 35 crores. Then I'm subtracting the interest cost, which is about 62 crores, and then there is another capex of about 100 crores, right? So overall free cash flow for FY22 is still negative 130 crores. My question is, how should we think of improving this cash flow and becoming cash flow positive, at least because you're talking about addition of another 500 crores in revenue that would entail another 150-200 crores incremental working capital for FY23. So just wanted to check how should we think of becoming free cash flow positive in FY23?
Good question, Sagar. The point is that I had guided that we will be over and done with major capex for all our projects in last financial year. Due to increase in commodity prices, especially aluminium, from 101 rupees kg to 180 rupees kg, we overshot the budget by 15 crores to 18 crores. However, we do not expect any capex, major capex in the current financial year. If you see that the focus on the new projects is institutional buildings, which do not require capex like in super high rises. You also notice that we haven't announced any super high rise order inflow, though we had big opportunities in that field over the last 6 to 8 months, because the capex over there is nearly 8 to 12% of the project cost, which means the cash outgo towards capex will be significantly lower in the current financial year, and only with the reduced cash outgo towards capex and increased margin due to enhanced turnover can the cash flow become positive after adjustments towards investing activities. And therefore, we do believe that there is a very good opportunity for the company to be cash flow positive in the current financial year.
How much would be the capex estimate for FY23 then?
So the capex estimate for Vashi, including Vashi truck terminus, is 24 crore rupees, and the rest you can say 6 to 8 crores. So about 42 crores will be the total capex, but this will be project specific. And obviously, the depreciation would be close to 43 to 44 crores in the core assets. So the net increase in the core assets will be nil or maybe on a lower side.
Okay, so this 42 crore number is including the maintenance capex, right? So including the this overall would be 43 crores, right? Versus which was about 102 crores.
Yes. So Sagar, I would like to clarify that maintenance we write on the face of the P&L account and we never capitalize that. We only capitalize new purchases. Any maintenance, minor, major, is capitalized, is written off on the face of the P&L account. Hello.
It seems that the participant has dropped from the question. We will move on to the next question, sir. We have the next question from the line of Anjana Shah from Shah Investment. Please go ahead.
Thank you very much for this opportunity, sir. So I had two questions. First, I just want to understand that we have lost around 45 crore of revenue due to change in contract term of large private clients. So can you please tell us regarding this contract? Also, are we expecting any further change in contract in coming quarters with any other client?
No, we are not expecting any change. In this instant particular order, the base rate was 27,000 per metric ton, and the price of the steel had gone to 72,000 per metric ton, plus taxes and transport and unloading charges. So in nutshell, you are procuring material at 75,000 rupees a metric ton, while the base price in the tender was 27,000. Now you can imagine that if you start investing at the rate of 75,000, where your base price is 27,000, it's a substantial money inflow which happens, and the reimbursement of which comes on a quarterly basis. So that's the only change. No other terms and conditions of the contract have changed. On the contrary, performance guarantees have come down. So I don't expect any changes from any other client in the coming quarter or quarters.
Sure, sir. And secondly, sir, if you could throw some light on our other income, because what has happened is it has halved compared to last year. So if you could throw some light on it.
1 minute, please.
Flat income, other income. Scrap sales and this.
Can you please repeat your question, ma'am?
Sir, my question was that other income, YOI, has halved. It's reduced by 50%. So if you could tell me the reason for it.
Other income. 1 minute, please.
Sure, sir.
It's basically scrap sales. It has doubled the other income, other operating income.
No, sir, I'm not talking about operating income. I'm talking about other income, which is the non-business income.
Non-business income.
Yes.
There is an impact of 3 crores in the service charges, and if service charges is nothing but the rentals which we charge from our joint venture companies for equipment which are provided. In this instant, for the current financial year, there is a reverse charge of 1.52 crores, thereby having a total impact of 3 crores. Hopes that answers your question.
So, sir, can we assume this to be as a one-off situation? Is this an exceptional item?
Yes, it's a one-off because we do not at the moment have any other JV save and except with Tata Projects. And in that, I do not see the company receiving any equipment. It may give away some equipments on hire, and if that happens, there will be an increase in equipment hire charges or service charge income, as the case may be.
Sure, sir. Thank you. Thank you very much. That answers my question.
Thank you. We have the next question from the line of Samir Dalal from Natwarlal and Sons Stockbrokers. Please go ahead.
Yeah, hello. Thank you for the chance to ask the question. It's in regards to this contract that has changed. You said 45 crores of revenue, of course, was not recognized, and of course, because of which the EBITDA profile changes. So my question to you is, cement and steel, a lot of it is a pass-through, right? Like you said. So with revenues coming down, if I were to look at EBITDA margins, the margin profile should actually increase, right? Based on the fact that you don't have it in the revenue front. So why are we not seeing that in the EBITDA margins?
You are seeing an increase on year, but you cannot compare to the pre-COVID year because the revenues were more than 1,500 crores. Your salary bills were similar. So the point is that there is an impact when your revenue dips to 1,340 crores as against 1,550 crores. Your fixed cost remains the same, and that is why you see an impact on the EBITDA by nearly 1.5%. So that is the reason why you do not see a positive impact on the EBITDA, even while there was a 45 crore impact on the top line because of not recognizing concrete and steel, even though it had a pass-through.
Okay. Okay, the second question is regarding, again, that somebody was already asking regarding the cash flows, and it's a continuation to that. So when we go up to about 1,800 crore turnover, our working capital cycle, it's at about 90 days. Will that remain at these levels? That means will the working capital, or do you think you can bring down the working capital a little further? Because that eventually even comes down to the same question, which is how the cash flows can be managed.
So you please have a look pre-COVID levels, especially the ILFS levels. The net cash flow was 56 days, excluding retention money, okay? And this had gone up to 181 days in the last financial year because of COVID impact. 159 days to be specific. This has come down to 99 days at the end of 31st December quarter, and we had guided that it will come down substantially. So it's come down by another 10% to 90 days now. You will see a significant improvement in June quarter and subsequent quarters. Intention is to be at that 56-60 days level, excluding retention money, by the end of the current financial year, as was guided earlier.
So that will be some amount of release from the cash. I mean,
that will be a substantial, because the point is that your project traction has already started. As I told you, the first 2 months of the current fiscal have seen a good traction as far as revenues, in spite of the free issue material is concerned. And we do believe that these things will positively impact 2 aspects of the business. Convert WIP into sales and therefore debtors, and realization of which will have an impact on working capital cycle. Number 2, the creditor levels, in spite of increase in commodity prices by nearly 70-80%, are at 503 crores or thereabouts. We see a slight increase to 550 crores to pre-COVID level. This will again impact the net working capital. So these 2 in tandem with increase in growth in revenue will show you the results which you are expecting.
Okay, great. Thank you very much.
Thank you. We have the next question from the line of Nisha Desai from Raga Securities. Please go ahead.
Yeah, good morning, sir, for taking my question. So I just have a question. If you could give us an update on the MADA project, I mean, what is the current status about it?
So the MADA project, which is being executed under Tata Projects Capacit'e Construction LLP, work has started on 6 rehab buildings of 40 stories each. Apart from that, we expect 10 buildings further. So total 16 buildings to be under construction in the rehab portion in the current financial year over various periods. And we have got IOD and CC approval for the sale buildings of 6 towers. We expect 2 towers to start after 3 months once the wind tunnel test is completed. So this is what we foresee as far as the current status as far as the MADA project is concerned. On the revenue front, as I already answered in earlier question, given the current status and the commitments from the client for approvals and handovers, we anticipate a revenue at the LLP level of 500 crores.
Okay, sir. So that was quite helpful. Thank you, sir.
Thank you. We have the next question from the line of Parvez Akhtar Qazi from Edelweiss Securities. Please go ahead.
Hi, good afternoon, sir, and thanks for taking my question. First question is, if you could give some update about the CIDCO project, what is the work status there, and have we got all the work orders for all the sites?
Hi, Parvez. The total status remains that we have received the 7th site also, but the environmental clearance from the client side is pending. So in effect, we have 48% of the land available. The company, as an exception, I tell you, has billed 22 crores in the current month for that project, and we expect that amount to increase by 33% over month on month for the next 2 months. So we should be reaching the peak for the current land availability in the next quarter. That's number one. The last the location, I expect that given the current status, the environmental clearance should take about 2 to 2.5 months. And once we have that, we shall promptly intimate you.
Okay. And in terms of debt levels, where do we see, let's say, by end of FY23?
So if you look at our debt level at the end of the last financial year, March 21 was 297.99 crore, which included CC, term loan, emergency line of credit, and a small portion of COVID loan of 1.63 crores. As of March 22, after utilizing close to 70 crores of additional debt taken, we stand at 282.42 crores. So I do believe that this debt will increase by close to 50 crores in Q2, and thereafter you will see reduction of close to 75 crores by the end of the current financial year.
Great. Thanks. That's it from my side, and all the best.
Thank you.
Thank you. We have the next question from the line of Deep S from Banyan Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a question on the debt side. So are you saying that the debt by the end of current financial year will be more like 215 crores?
I cannot give you an exact figure. However, you may note down that our total debt as on March 22nd gross basis stood at 282.642 crores. Excluding promoters' debt, which will continue to remain in the company, and at some portion may get converted into equity. So 282.42 crores. Add to this, as I told you, there will be a short-term increase of 50 to 60 crores, and thereby thereafter a reduction of 75 crores by March. So, nutshell, your debt should remain at close to 305 to 310 crores by the end of the current financial year on gross basis. On net basis, obviously, you will have to reduce another 190 crores to arrive at that. So the net debt continues to be close to 120, which is consistent with what we have been projecting in the pre-COVID period and over the past few quarters.
Right, that's helpful. And I think earlier you had guided that you will be completely debt-free by September 2023. So does that timeline still stand, or that has also changed?
Obviously, with the COVID in the first quarter, we remain committed. If the bank releases of the margin happen, we shall be close to being debt-free in the early part of the next financial year. However, I will be able to give you a very firm and a committal answer in the first quarter conference call. Please remind yourself to log in, and you shall have the answer.
Okay, that's helpful. And just on the business side, how's the sentiment in the pipeline? And the reason I'm asking is, given the commodity price increases, are you seeing the builders pulling back on their projects, and therefore, the deal pipeline has come down? If you can just give some commentary on that side.
You will see certain negative impact on the very low-cost housing. I am not talking about affordable housing. Low-cost housing means where the sales were happening at 2,500 and 2,800 rupees, because my guesstimate is that the overall impact on construction will range between 400 to 600 rupees due to commodity increases. And in a very low-cost housing project, that's a sizable amount to wipe out the entire profitability. especially when the sales have already happened in the recent months. So since we are not in that segment, very low cost housing at all, the impact on that does not happen to Capacit'e. Having said that, the traction both in government and private sector is very, very high. Good developers continue to benefit. Consolidation in SRA is going to happen. There has been a latest government resolution whereby wherever financial institutions' money has been stuck in a SRA project, they are allowed to take a new developer of repute, and SRA will transfer that project to the new developer and the financial institution consortium, waiving out the 5% premium charges. These things are very positive, and obviously the traction looks very, very strong. I should mention that healthcare, the traction is at the highest level I have seen in my career.
Okay. Thank you. That's all.
Thank you. We have the next question from the line of Jiten Rushi from Axis Capital. Please go ahead.
Good morning, sir. Thank you for taking my question. Sir, on the Sidco front, as you said, your book revenue of your build for
Mr. Rushi, your voice is coming a little low. Could you come closer to the mic?
Can you hear me now?
Yeah.
Yes.
Hello. Yeah. Yes, sir. So as you said in the recent question that you are expecting your build for 22 crores in April for Sidco. So what kind of revenue we can expect in Q1 and Q2, and then in Q3, Q4 once you get the land parcel, remaining land parcel, and the total revenue from Sidco in FY23?
Let's not talk about the total revenue including location 7. We would like to only give what is available. 2348 crores is the land available on which construction is going on at the moment, which is close to 47-48%. And as I told you, the peak from next quarter over there will be in excess of 40 crores. What I mentioned was that in month of May we have built 22 crores. Month of June we will increase that to 31 crores, and in subsequent months it will be close to 40 crores. Taking that into consideration, we believe that we should easily be targeting close to 450 to 500 crore revenue from Sidco in the current financial year. However, if in case we happen to lose 50 crores over there, we have sizable revenues coming from MCGM, hospitals, 2 of them, and JJ Hospital. And that is why we are very optimistic on the 1800 crore revenue guidelines.
Yes, sir. Okay. And sir, this 500 crore of MADA revenue, which is in LLP, our share would be pro rata, right, sir?
35%.
35%. Got it. And sir, you also talked about the commodity price hike. So you said that your order book is fully covered with price escalation. So at the EBITDA level, there is no impact. Is my understanding correct, sir?
Yes, absolutely.
Correct. Okay. And sir, on the coming back to few balance sheet numbers, so can you highlight unbilled revenue, mobilization advance outstanding, and retention money outstanding as on March, and also the free cash?
Yeah. The total unbilled revenue has come down to 456 crores. Out of this, in the last month, we have already got bill certifications of 60 crores. So that will be another reduction. Your second question was cash on the books. Cash on the books in fixed deposit, it's close to 187 crores, I'm sorry. This includes an amount of 27 crores lying in the bank's CC limits, free for utilization.
And free cash would be how much, sir?
27 crores is lying as free cash for utilization.
Okay.
However, this does not include the free LC limits of close to 55-60 crores, which are also available for working capital.
And sir, on the mobilization advance outstanding and retention money?
The retention money is 160 crores and the mobilization advance other than CIDCO is 140 crores and it is approximately 246 crores from CIDCO. So you have close to 386 crores of mobilization advance. However, CIDCO will reduce by approximately 110 crores in the current financial year.
Okay. So these are interest bearing, right?
Non-interest bearing, none of our advances are interest bearing, except MCGM 16 crores, which is a very, very minuscule part and is captured in the finance charges.
Got it, sir. And sir, on the bank limits, total bank limits, and what is the fund base and non-fund base and the utilization level, please?
The total SS limits for FY22-23 assessed by the lead bank SBI are 1130 crores. Fund base is 190 crore, utilization is 120 crore, non-fund is 940 crores, and bank guarantee utilization is 410.7 crore. LC utilization is 145.18 crores.
Great, sir. And sir, again coming back to the opportunity pipeline. So with the interest rate cycle going up, the commodity cycle expected to cool off. So will this help us in terms of new order inflows because it's getting offset with the cooling off of commodity prices? Do you see strong opportunities from private developers?
We should wait for at least a month before deciding on the commodity pricing. It has been more volatile than ever seen in at least my career. We have seen 43 to 60, 72,500 in a period of 2 months, and we have seen a fall of 12 rupees kg in a time period of 9 days. Now, with the export duty of 15% in place, if there is a crash in the coal prices, you will see a correction of 7 to 8 rupees kg. That is my guess. Please do not take it for granted. However, the price coming down to 50,900 plus 3,500 as other costs, I still believe that there is a big relief for the developer community. Number one. Number two, but no one is going to act in haste. And steel is not only the one part. The non-ferrous, the aluminium prices, which had gone to 275, 280 rupees kg, seeing an 80% increase over the last 15 months. That should also cool off. Similarly, the copper prices have to cool off to see meaningful decrease in the MEP costs. So please wait for a month before we come to any conclusion.
So just one last thing, we have seen reduction in the order backlog of 45 crores. So this reduction is full and final, or we will see further reduction in that in the last project which we are executing right now?
No, the order book is of 9,000 plus crores, accounts for the entire reduction of steel and concrete in that order.
Got it. That's from my side, sir. Thank you and all the best for the new financial year, sir.
Thank you very much.
Thank you. We have the next question from the line of Sagar Parekh from Deep Financial. Please go ahead.
Sorry, my line got dropped in between, so I couldn't. Regarding my question on the cash flow, so you mentioned that about 40 crores will be the capex for FY23, right? 42 crores.
Yeah.
Okay. So basically, then we will be cash flow positive. And did I hear the debt number correct? You said that by the end of FY23, your debt would be 305 crores?
Approximately on gross basis.
Yeah, on gross basis, 305. So that is still an increase of about 20 crores from, I'm talking about ex-promoter debt. So that is still an increase from FY22 levels, in spite of us being free cash flow positive. So just was trying to match the two numbers. Why would our debt increase if our cash flow is positive?
That's true. See that we have to give an indicative figure of the limits we are going to be enjoying. You always have some cash balances available. The question cannot be answered on exact terminology basis that I will be at 271.5 crore. I have said that the company will require close to 50 crores to further peak up its operations, and thereafter the reduction will happen. Now we are targeting reduction of minimum 75 crores, and that obviously is going to happen through two things. One is through the cash flow improvement, and secondly through the margin improvement with the banks. Okay, no one intends to keep 190 crores at 5% and 4% in the banks. So what I have given is the maximum overall debt level anticipated for FY23. Yes, you are right that does show a 15-20 crore increase over the current financial year. But as I told you, people were expecting an increase in the current financial year also. But even after availing 77 crore of additional debt, there has been reduction in the overall debt by nearly 10 crores. So the same thing would happen because we are not taking into account at the moment the terms of 60 crores, of which nearly 36 to 40 crores will be prepaid in the current financial year. So if you take that into account, your total net debt will be 305 minus that 36 to 40 crores. But whether it is 36 crore or 37 crore, don't hold me to ransom. That figure could be 1 or 2 crore plus. So I am giving you the bank limit availability on working capital. Term loan, as you are aware, has shown a reduction year on year, and there will be a reduction of at least 36 crore in the current year from the term loan repayment. So on term loan plus working capital basis, you will see a reduction of 305, 306 minus 36 crores.
Okay, so this 282 crore excluding promoter debt is inclusive of the term loan, right, as of March 22?
Absolutely.
Okay, and this 305 crore which you said earlier was only the working capital loan?
Working capital, so you will have to imply the reduction in the term loan, which approximately is 36 crores. And if you put that, you will be lower in the current financial year. Let's hope that the bank sanctions are at more lucrative from margin perspective. We shall we have already the assessment note from the lead bank. Once we have the revised sanctions in place, we will be able to give a more promising or accurate commentary in quarter one of the current fiscal conference.
Okay, great. So my point was that at 1800 crore level also, if your debt levels remain same or probably go down, then the company looks in a good footing. So just wanted to give my feedback on that, that probably try to match your numbers by not increasing the debt basically. That's the only point I have. Thanks.
We could have increased our revenue to 1500 crores.
Yeah.
I decided to take debt this year. Yeah. We believe in long-term strategy. We have seen 2 tough years, but we have not wilted away from our aim of ensuring that the operations have to grow only on the basis of the cash flows generated. And that is what we are focused on.
Okay, great. All the best, and that's it from my side.
Thank you.
Thank you. We have the next question from the line of Verma who's an individual investor. Please go ahead. Mr. Verma, we can't hear you. Please go off the speakerphone. Mr. Verma, this is the operator. Can you hear us?
Hello.
We will move on to the next participant. We have the next question from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yes, sir. A couple of clarifications. So this 1800 crore revenue is purely your share, right? So when you mentioned that Sidco will be 400 plus and your share is 25%. So when you're mentioning this 1800, you're mentioning versus the 1300 plus number which you mentioned this year.
Yeah, it is our number, standalone financials of the company.
Okay. My second question is, sir, where are we on the debt rating status? And there was this one press release about 200 crores debenture raising. So now this is against swapping of our existing debt, or I could understand this press release?
Number one, the rating was upgraded within 3 months, stands as a record to BBB, stable in now.
Yeah, but we were, I think, A.
Yeah.
Yeah. So I was just thinking from that line.
Yeah. So BBB, no one could have, the same institution possibly couldn't have given A within 3 months. However, we will be approaching them with the new financials. Our due date is August again, but we will be discussing them to approach them after Q1 results. And obviously, we will be seeking reinstatement of our A rating.
Okay. And the debenture, yeah.
Yeah. Secondly, we have never mentioned that we will be raising 200 crores as debenture. We have given an overall approval for 150 crore. However, we have raised 100 crores as debenture. That is the increase in debt which we mentioned. That is a part of the debt profile which we have mentioned to you. And there will be no further increase in debt increase through debenture henceforth. So that 150 crore was only an enabling resolution. The company decided to restrict it to 100 crores, which is a part of the overall debt.
No, sir, I am confused now. So the 130 crore net debt that we see, or the 328 crore gross debt, that have we raised it, or is just an enabling resolution?
It has been raised. We have raised on 31st of March.
Okay.
And out of that, 80 crores was raised on 31st of March. All right. And close to 60 crores was already utilized. So it appears in your balance sheet, in the debt area.
And this 128 crores you are saying will first rise, or net debt will first rise by another 50 crores, and then we will see a tapering off. That's how you are mentioning, right?
Yes, because you are trying to increase your revenue by 40 crores with a net working capital of 90 days. You're looking at approximately increasing the cost of 75 crores, and that is why I said, including the inflows and margin release, 50 crore will be the additional debt increase you will see, and subsequently you will see a reduction of 75 crores on the working capital side. Apart from that, the repayment of term loans will constitute 36 to 40 crores.
Okay. And so my last question.
Yeah. So overall, on the overall debt, you will have a similar or a lower figure than the current financial year. That is our expectation. However, as repeated earlier, we will be able to give you a perfect commentary answer during our conference of June quarter.
Okay. And so my last question is, we see a lot of construction activities obviously happening around in terms of newer projects, but when I see your inflow, it's still not reflecting. So any comments there?
So the order book stands at 9,500 crore currently, with L1 position in nearly 600 plus crores. That's more than sufficient. The order mix is 60-40 between private and government. Now, with the revenue projection of 1,800 crores, we can only book the orders which get executed in the current financial year. There is no harm in going and taking orders and spoiling the EBITDA profile of the company or the cash profile of the company. The point is that why do you say that we should go and book orders more than 4,000 or 5,000 crores? The company's order book is stable at 9,000 crore. Once we achieve 2,500 crore, obviously the order book target will go to 3,000 crore. And the company over the existence of its 9 years has proved that it has always taken and improved its order book profile both from quantity and quality perspective. So this year we have given a guidance of 2,000 to 2,500, and we are more than hopeful of achieving that.
Okay. Thank you.
Thank you. We have the next question from the line of Darshan Diora from Invest Capital. Please go ahead.
Hi. So your order book is quite large. Wanted to understand from you that what is the impediment for executing on this order book? Is it shortage of labor? Is it working capital challenges? Or is it site availability?
Mix of it. Site availability was there pertaining to CIDCO up to quarter 4 mid, which I had explained last time. That has been removed. Only one location constituting 50% is balanced to be given, and that is why our current year's revenue guideline does not include that location, which is expected by end of quarter 2. Now, there were working capital challenges, which we have overcome by raising about 100 crores of non-convertible debentures, which form a part of our debt, and therefore there has been increase in revenues in April and May of the current financial year. Point number 2. What was your third question?
Regarding labor.
Labor will always be a challenge, right from L&T to the smallest contractor. So we have close to 15,000, 16,000 workmen boots on the site. We have to take it to 19,000. And in India, we have a lot of festivals. The latest was Eid, and the labor is returning from Eid. You should have excess labor with the onset of monsoon. So at least for over the next 3 to 4 months, we don't see any labor challenge. But as you know that there is a lot of infrastructure activity going on. So there is infrastructure boom in buildings. It is there in the road sector, highway sector. It is there in the metro sector. It is there in practically any and every sector which you see is at the peak of order award and execution. So there will be shortage of labor, and only how well you pay them will be the determining factor to retain the labor workforce at site. That is what we are focused on, and 15,000 to 16,000 workmen is only suggestive of the steps which we have taken to ensure that we retain that labor strength.
My second question was, regarding the price increases. So as you guided, most of the price increases on the commodity side sort of can get passed on to the client. What about any increase in the labor cost?
We haven't seen any significant increase in the labor cost, which is visible from our construction cost expenses. The labor subcontractor charges continue to be between 21 to 22.5% over the last 4 years. Obviously, a portion of that also comes with enhanced revenue. Second part is that in the private sector, we add the labor cost escalation in the pricing itself. In the government contracts, there is an escalation cost to cover the labor cost increase. So it is not that we are uncovered for labor. We are covered, but I cannot say 100%, maybe up to 80 to 85%. But the balance which is taken into consideration during estimation takes care of any overspill. However, when you see our financial, you will see that the stability in the cost of construction labor, subcontract charges, when you get the entire consolidated balance sheet, it is given in the reference note number 34, which shows that stability of labor to our sales percentage has been very stable over the last 4 to 5 years.
Thank you. Thank you for answering these questions. That's all from my side.
Thank you. We have the last question from the line of Deep Sangoi from Banyan Capital. Please go ahead.
Yes, hi. Thanks for the follow-up. Just wanted to clarify, this 100 crore NCD is included in this 328 crore number. Is that correct?
The utilized portion is included. The unutilized portion of 28 crores is a part of the cash. However, as I told you, any increase in this will get offset by the repayment of term loan.
Right. So you're saying 328 plus another 30 crores of NCD is to come, and that 30 crore is part of that 50 crore you talked about that the debt will go up to. Is that the right way to think about it?
Absolutely.
Okay. And then what is the interest cost of this NCD?
I can give you the average interest cost is at between 9.5 to 9.75% for the company on overall. Different costs, this is unsecured, and therefore it will be higher than the bank rate. But on an average, the rate of interest is average, sir. 1 minute, please. So that same thing, about 9.5 to 9.6% is the average cost of finance for fund-based limits across, including term loans.
Understood. And then there was a notification that promoters are going to do a preference round. So should we assume there will be new capital infusion, or are you going to convert your existing loans into equity?
Our existing loans will be converted into equity to enable the company bring down the debt by 55 crores.
Okay. All right. Thank you. All the best.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Katiyal for closing comments.
Thank you for participating in the call. We hope we were able to address all or most of your concerns. If you require any additional information, please contact SGA, our investor relations advisors. Thank you very much, and see you in the next quarter. Bye-bye.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.